The Bob Murphy Show, episode 472.
There's a tidal wave coming. What you gonna do?
Get ready for another episode of The Bob Murphy Show, the podcast promoting free markets, free minds, and grateful souls. It's your source for commentary and interviews conducted by a Christian and economist. Now here's your host, Bob Murphy.
Hey everybody, welcome back to The Bob Murphy Show. This episode, I'm having a conversation with Pontus Rendahl. Now, where this discussion came from is, and we talk a little bit about it when we get into it, I'm not sure exactly what sparked the whole thing, but there has been brewing on Twitter/X for a while a discussion of heterodox economics and, its defenders and detractors. And so a while ago, Pontus had jumped in with this thread where he said, hey, when I was at the University of Cambridge for economics, I really did try to reach out and build bridges with some of the heterodox people that were either there or that were, visiting and giving presentations and whatnot. And he said, I really tried to extend an olive branch to understand where these folks were coming from. And his conclusion is, he has this long Twitter thread, was that there really wasn't much there. That, anything that was significant, he felt that they were presenting were things that people in the neoclassical mainstream already knew about and had tools to handle if you wanted to go down that route, and that there was a lot of smoke and mirrors. Okay, so I'm obviously summarizing it very simply, but you can check out his thread or, listen to the conversation that he and I are about to have here. So just to give a little bit more background on what Pontus's history is, he got his PhD in economics from the European University Institute in Florence, Italy. He has been at the University of Cambridge. He was an associate professor there from 2011 to 2017, and then a full professor from 2018 through 21. And of course, that period is the backdrop for some of the stories he's going to tell. And then currently he is at the Copenhagen Business School as a professor, and he's also the editor of the Scandinavian Journal of Economics. So without further ado, here is my discussion with Pontus Rendahl. Well, Pontus, welcome to the Bob Murphy Show.
Thank you so much. Thank you for having me.
Sure thing. So I would have already given a little bit of this context to the listener in the pre-recorded intro, but for those who just skipped that to dive right into the festivities, you came on my radar. Maybe there's been like this brewing debate for a while now about, well, I guess it started because there was a piece about math and economics, and people were arguing about that, and it kind of just generally spread into the heterodox people versus the neoclassical mainstream. And then you had chimed in and said, basically, yeah, I spent some time and I was in this post, and I was trying to really understand and build bridges with the heterodox critics, and you were that didn't go well. And so that's why you're here. So why don't I turn it over to you? Maybe can you perhaps just give a brief background just so the listener knows where you're coming from, and then you can tell your story?
Yeah, sure. So I think, first of all, I read on Twitter quite a bit. There were these discussions. I have a vague recollection of this math and economics. Do you recall who wrote that?
It was Tim Worstall or something like that, I think.
Okay. No, Tim Harford.
Or Harford, yes.
Yeah.
I mixed up my Tims.
Yes. Yeah. For the Financial
it was like
Times.
the FT, yeah, right.
Right. Well, that was one thing. It just started popping up a little bit here and there. There's a couple of accounts that are associated with heterodox economics, like Steve Keen is a prominent figure. There's a character called Relearning Economics. There used to be one called Unlearning Economics, and so on. There's a couple of them, and I sometimes see my more mainstream colleagues engage with these accounts, and it doesn't go very well. And at the same time, I was seeing these things, and I have a natural instinct of engaging in things that perhaps shouldn't engage in. But I withheld from doing that, and but after a while, I just thought I'll just write a little bit more broadly about how I feel about this discussion and what my experience was. So I wrote this thread. I don't know, maybe there were 10 tweets or something like that, and it actually got quite a bit of attention, and I think it got attention because many people felt like they've been in the same situation. And I also think that my guess is that quite a few people found it interesting because I explained it from the perspective of having been working at Cambridge, which is somewhat of a hotbed for at least post-Keynesian economics. So do you want me to provide a bit of a summary what I wrote?
Yeah, I do, but before you do that, can you just back up a step and just explain like it can be really quick, but just like your career and like where you were and how you ended up to be at Cambridge. And also for our listeners here in the US, like, for example, I'm familiar with Cambridge primarily because of the Cambridge Capital controversy. So remember, Americans don't know that anything on planet Earth outside of the boundaries of the United States. So can you just give us a little bit of like the history of the Cambridge, in terms of economics and what they're known for now, and then how did you end up there?
Of course. So Cambridge University in the United Kingdom is one of the oldest universities in the UK and one of the oldest universities in the world. I think Oxford is a little bit older, and I think Bologna is older in Italy. And it's also known to be a high quality institution with.
Like, is that where Isaac Newton was?
I believe so.
Okay.
Darwin was for sure there. It's founded in the 1250 or something like that. And it was also the place where Keynes were, Marshall, Pigou, a bunch of these economists that were setting the tone about 100 years ago. There was a bunch of philosophers like Russell Brand or Frank Ramsey was there as well. So it was really the epicenter of the intellectual world at one point in time, at least, and certainly for economics. And out of these, so this is my reading of the history. I can't vouch for, I'm not a historian in particular when it comes to Cambridge, but of course I have heard quite a bit of the history. But after Keynes, he had his disciples and that followed him and learned a lot from him. John Hicks is a famous name that often comes out because he was the founder of the ISLM model, which was a mathematical interpretation of Keynes' general theory. And with these disciples, there was a type of Keynesianism that grew out of that, where Keynes, long gone, were not part of it, but it was developing. And I would say about the 70s, 60s, 70s, there were a couple of events that happened that invalidated at least parts of those lines of thinking. One was the stagflation of the mid-70s and running up to the 80s. And at the same time, there were new intellectual ideas developed by a then heterodox group, people like Robert Lucas and Tom Sargent, Chris Sims, and so on, that was sort of part of this revolution in macroeconomics, where macroeconomics became more like micro. And model agents from that perspective. Rational expectations, I suppose, has a certain place there too. But it was let's say a competing school of thought that became the dominant paradigm. Now, at a place like Cambridge, which was a stronghold of the previous way of thinking, the disciples were still there. I suppose the tenure system, to some extent, make those changes very sluggish, in particular in an institution that has been very strong in a particular subject, which meant that the development at Cambridge towards this new school became slower. It also meant that with let's say, more mainstream economists that were there. Frank Hahn is a name that should be mentioned. I think there was a significant amount of infighting within the institution. And now we're talking about the 80s, maybe perhaps 90s. At one point, they divided the faculty or department of economics into a faculty of economics and a faculty of applied economics. And
well, can I stop you for a second?
Yeah.
Because what's interesting there, just from the way you were saying that, one might suppose that, the dividing line was between like Robert Lucas and like Fama versus standard Keynesians. But I mean, the standard like a Paul Krugman or somebody would be like MIT.
Yes.
But of course, earlier in the famous Cambridge Capital controversy, it was MIT versus, you're at Cambridge. And so can you just be like in the 80s, when like the Chicago guys were going head to head, like in the US, we would call it saltwater versus freshwater divide. Yeah. So I'm just trying to isolate.
That was the fight between Cambridge, Massachusetts and Cambridge, UK, right? So
was the Cambridge Capital. Yeah. Where like Joan Robinson and Schraffa and things were saying like, you can't aggregate capital into a single number. And guys like Solo were saying, yes, you can, or here's the conditions. So that's what I'm trying to isolate. Like, so here, and by the way, and like, guys like Paul Krugman say, don't even bother reading the Cambridge Capital controversy. We won. Those guys are idiots. So I'm just saying, when you're talking about like in your narrative, you're in the 80s at this point.
Yeah.
Are there still people who like think that the marginal revolution was misinterpreted and that the capitalists don't earn the marginal product of their contribution and it's like bargaining power?
Well, so I came to Cambridge 2010, and there wasn't any visible signs of that conflict anymore.
Okay.
I mean, as you say, that was a conflict between Samuelson and Solow at MIT versus Joan Robinson and Piero Sraffa at Cambridge, UK. And it was exactly about this. Can you, in a meaningful way, aggregate capital to one number and speak about the capital stock? And, famously, people say that MIT lost the battle but won the war.
Right.
And I think that's largely true. I think also we know now that aggregating just about anything to one unique number is incredibly hard, even things like real income, and doing that in a useful way. But in any case, that was not so much part of it when I was there. It was more a group called post-Keynesians that seems to be a school of thought that has sort of developed after that, but is holding very dearly to the ideas of Keynes. So they were there still when I was there, but they were not really in the faculty of economics. There were a few notable exceptions, perhaps, but it wasn't when I was working on a day-to-day basis that 50% of the department were heterodox economists. It was like 99% of the department were mainstream economists. But Cambridge is built on a college system where colleges are like professionally run student fraternities.
Okay.
Where you also have in-house tutors that are teaching students in small group teaching. So 2-3 students and a person that is called a college teaching officer, which is different from a person like me who was then a university teaching officer. So see these colleges as like a little bit souped up and fancy and a little bit more rigorous and very wealthy student fraternities where students live, eat, party, but also learn. So they were still there. And they were forming groups, and they were having.
Sorry, I had interrupted you. So your formal training. Like, did you just get a standard training?
Yeah, I have a standard PhD in econ. But this was, so I was a PhD student from 2003 to 2007. I learned all the standard mainstream stuff, but it was and you may remember this too, that this was kind of a boring period to be a macroeconomist, to be honest, because if you look at the history of macro, we had the stagflation situation in the 70s, which was a significant event globally. And in particular in the United States with unemployment rates at 10% and so on. But after that, When I was a PhD student, there had been basically two more recessions in the United States. It was the savings and loans crisis in the early 90s. It was the dot-com bubble in early noughties. And, nothing happened to the economy. We even spoke about the Great Moderation.
Yeah.
And the Great Moderation was referring to the fact that business cycles were basically gone.
You'd cured it. Yeah, you guys figured it all out, so there's nothing else to do.
Even Bob Lucas wrote an article about how we cured it. We fixed it.
Yeah.
So then came the financial crisis, which I then, as a very junior economist, just graduating with my PhD, the year after the financial crisis hit, or maybe in like the last quarter of 2007, the financial crisis hits. And for me, that was a little bit the gift that kept on giving, because it made macro highly relevant and business cycle research in macro highly relevant and very interesting for me. So when I came to Cambridge, I came with a very open mind, and in particular, I did have this view that after, we had this marginal revolution and rational expectation revolution in like the 70s, 80s, and after that, there hasn't been any real recessions. So the theories hadn't really been developed in the right way, I would say, because the data wasn't leading us in the right way to analyze events like the financial crisis. And instead, the focus was on more marginal topics like, risk sharing arrangement and whatnot. But all of a sudden, understanding big demand driven recessions became the number one priority, and which tools should be used. Now, luckily, we did have one experience, which was from the Great Depression, and we did have people like Ben Bernanke that had studied in detail the Great Depression and the policy mistakes and what would be the appropriate policy responses and so on. And I think that was a very good thing. So we did have something to learn from, but very little. So,
hey, Pontus, can I stop?
Yeah.
Is it? I'm going to make a statement, and you tell me if this is fair.
Yeah.
So I'll be deliberately provocative and exaggerate, but tell me, how that. From like the 1990s through the early 2000s, many macroeconomists literally didn't have banks in their model, and they were proud of that they thought we don't even need banks to explain financial recessions. And then after 2008, they said, oh, you know what? Maybe we should go back and look at the people who have been modeling banks, because maybe that is an important part of the story.
Well, I would agree with the first statement that it was very rare to see banks in the model, and when people had it in the models, it didn't gather a lot of interest. I wouldn't agree with that people were proud of it. I at least never heard it. So it wasn't something I was aware of. But it was clear that it was a neglected aspect. I would say probably to this day, I think it's.
I can send you one example. This guy Scott Sumner, I have in mind, who's do you know who he is or not?
Yes, but
he
remind me.
Proud might be a strong word. So he's he did a lot after like around 2009, 2010. He was doing a lot to say the Fed had been too tight, which at the time seemed crazy to people because they're like, no, the interest rates are zero and the QE. Yeah, and so the school of thought that's been named after the stuff is called market monetarism. So it's like they're the old school monetarists, and so they favor NGDP growth, targeting.
Right. Yeah. But that's the NGDP guy. Yeah.
So anyway, I mean, maybe proud is a bit provocative, but I remember he had a post one time where he was explaining why, no, I don't need, like, all I care about is NGDP growth. And if it's insufficient, that means the Fed is too tight. By definite. Yeah. And he said, I don't need banks in a channel of the transmission because that's just an extra complication. You know what I mean? Like, in other words, he was saying it's a virtue if I can explain things with as few pieces as possible. So,
yeah. Well, Occam's razor is always good, but, if you miss fundamental parts, it's the Occam's razor doesn't apply anymore, right? So, so I wouldn't say that I met people like that, but I would say, it was an overlooked aspect of many models, and probably because the data wasn't very compelling to say that this is really important. This can also be one thing that I think economics is suffering from, and in particular macro, is being very US-centric. And now, I'm from Sweden myself, so of course I have a little bit of a bias to look outside of the United States, but I do think that there's a lot of cross-country evidence for, in particular, financial crises, which you can learn from. It's not all about U.S. time series. We also have a panel. We have multiple countries with their experiences. We can learn from that, and it's been a little bit neglected, I would say. I mean, things are different now, but back then, that's how it was. There was actually a nice paper coming out in the American Economic Review. I think it was actually that year, 2007, about the permanent scarring effect from financial crisis compared to other recessions. So there was actually a really nice paper coming out, which was making the rounds at the time. Anyway, I also, added to this with banking. I think apart from banking, one thing that was a little bit missing at the time was, I think, gross variables matter. So it's not all about net debt, because if you and I are the only two people in the economy, your saving is basically my borrowing, and it's all a wash, yeah. But if you save a lot and I borrow a lot, things can get fragile, and I think that part that actually gross numbers matter, not only net numbers, was overlooked. But in any case, I came to Cambridge, and I was, I heard these post-Keynesian economists, in particular Steve Keen was one guy who was coming to Cambridge on a couple of instances, and I got curious, to some extent. You're kind of hoping that maybe I can take away something really valuable here, some unique insight that I can perhaps, if these post-Keynesians don't want to speak the mainstream language, I can do some intellectual arbitrage, and I can use those ideas, and I can translate it into the mainstream language, and I can write really nice papers about this. And that was one of the reasons I decided to engage, not in a critical way, but in a listening way. And I spent a couple of years doing that, but as I wrote in my Twitter post, I got a little bit jaded, and I got jaded because I was met with a lot of hostility, and I was not met with curiosity, which I came in with myself. And this was despite, I have a couple of memorable situations that I were involved in. I was a discussant on a paper at a small conference, and this was organized in these colleges that I spoke about before. And instead of feeling like at a standard conference, you have a presentation, then you have a discussant, and the discussant's job is to act like a verbal referee or something like that, which is providing feedback but also criticism to the paper. And when I did that, I was met with, it became a little bit like the room against me.
Right.
So it wasn't at all that, let's take this criticism seriously and let's engage with it. And things like you wouldn't see at a mainstream. You can see disagreement, but you wouldn't see like ridicule. Or I discussed this this was at a student organized event. I discussed this paper by Steve Keen, and Steve Keen was there. And that's the one I sent you the slideshow to my presentation, and that was that was the same. It's intact since 2011 or 2012 or whenever it was done. And what I tried to do there was actually represent some of Keen's ideas in the mainstream, and showing how the same ideas are dealt with in the mainstream, and so on. And I honestly think that event was quite a success, in the sense that the audience members largely enjoyed both sides of that debate. But afterwards, I had this older post-Keynesian. Well, it was during the Q&A session, and he asked me why I didn't do everything I did using measure theory. And you can look at my slides there if you want to, but you can see that everything I'm doing is static and deterministic. There's no expectations. There's no integrals. There's measure theory has no place in that framework. And I realized afterwards that he was just rigging it as a gotcha, to try to expose to the audience that I didn't know enough mathematics. I did know measure theory, and I said you can interpret every equation I've written in measure theory and just say it's measure one. And then he got very upset with me, and he started shouting and so on, and this caused a little bit of a stir. Both the students found this like somewhat.
Hey, can I stop you and just make sure that the listeners are catching? So me too. Is this what happened? So Steve Keen goes there and he presents, his view and say, hey, these mainstream guys, they don't understand that money's created by the banks, and they don't know how accounting works, and endogenous money, all this stuff. Yeah. And then then you get to give your reaction, and you're saying, yeah, he's got some interesting ideas, but there is machinery in mainstream economics that can handle all the things he's trying to model. Yeah. So here you go. This is the way you would do it. Yeah. And then someone challenged you and said, how come you don't use measure theory? And measure theory, that's really good for like probability and stuff. Yes. And you were saying, well, because we're not worried about the future being open-ended and random variables being real, like there's no reason you'd even use measure theory. Steve Keen's model is deterministic. There's no uncertainty. So okay, I can put probabilities, but everything would be probability one.
Yeah, that's gotcha. The correct interpretation.
And then he thought, this guy doesn't know measure theory like Steve Keen does. Okay,
I suppose so. Yeah, okay. Yeah. But he probably realized by my answer that I actually knew how it worked and knew that it wasn't appropriate for the setting. But I think he was hoping that I would be taken aback and start to stutter or something. But in any case, that it's more to illustrate like the hostility I felt in this sense of. I think maybe I naively expected something like, let's work this out together. I show you my model. I'm going to lay it out. You lay it out how you see it from your point of view, and let's see if we can meet somewhere. But sorry, I keep interrupting you, but you're right. That I've encountered this in different contexts as well, that if there's a group of people who are sort of like outside the mainstream and they keep saying, these, the popular people don't know what the hell they're doing. We're doing it right over here in our little corner. Yeah. And so then when there is someone from the mainstream who comes over to say, what are you guys working on? That person thinks, you guys are at least glad that I'm at least giving you a chance, right? When instead, sometimes the way it turns out is they kind of like being out and ostracized because it proves that, they're ignored geniuses or something, and that this person coming out is like, no, you wouldn't get it. The fact that you're from the mainstream, you don't know what's going on. And, I mean, that's a bit of a psychological interpretation of why things are happening, and I'm not disagreeing with exactly what your hypothesis there of what could be the underlying reason for this behavior, but it is, what I was seeing is perfectly consistent with that explanation. It was.
I know I keep interrupting you, but I'm sorry.
Yeah, just to clarify, I appreciate your interruption.
Because just so you know, Pontus, I'm an Austrian school economist. So I'm saying, I know. I've been on the other, you know what I mean? Like in other words, most people in my career have been telling me too that I'm just some fringe nut job, and why don't you guys go learn some math, right? So anyway, I feel like I can move in these circles, and I kind of understand where everyone's coming from in the pitfalls.
But that's not really my issue with this. So my issue has been this. I wish there was. Why don't a guy like Steve Keen or some of the people surrounding him, he would say, let's write down my model and you write down your model. Let's see where they start to fit each other. And if you would do that, you're going to have, we both agree on, the GDP identity. We both agree on the government's budget constraint. We both agree on, there's going to be a bunch of things that you are going to agree on. Even also things like MMT. I think the nuts and bolts equations of like, these are restrictions, these are physical limitations in the economy. We need production somewhere. We need, we would all agree. Then the question is, how do we tie these things together? And there I was hoping that something, really nice would come out of it. But one example, I realized I didn't phrase that particularly well in my tweet, but one example was that Post-Keynesian economists would speak about radical uncertainty, and basically uncertainty that is not, I don't know, graspable by the human mind, and not you cannot mathematically model it, and I think that's what they mean, and but in my model, I deal with radical uncertainty. And if you actually go through the equations in the model, you see that they have the old Keynesian consumption function, which was actually in Keynes' book, the general theory. Which means it's a linear consumption function where consumption depends on current disposable income. And it's like, well, that's all fine, but it's not a sophisticated way of dealing with uncertainty you just mentioned, and then telling me that whatever I do is wrong. So I did meet that type of let's say disappointments. Okay, and lately I also, it's MMT is something that is discussed a lot, and every time I see it being written by people, I don't know if these guys are particularly prominent or not, but it's basically always this statement that the government can fund whatever it needs, because it's a sovereign and it has its own currency. And I would say the mainstream wouldn't disagree with that. It's perfectly in line with the budget constraint that you can fund your entire enterprise with printing money. It's perfectly possible. But the downside is that it's very likely to give inflation. And then the question is, okay, so at one stage, I think I wrote to someone, what you sometimes call the equation of exchange, or the quantity theory, which is this: money times velocity is equal to the price level times inflation. Times real GDP. And then if you increase money, then three possibilities can happen. One is that velocity declines, and that's about it. Another one is that real GDP increases, and that's it. And a third one is that the price level increases, and that's inflation. Or a combination of these three can, of course, happen. But if you want to say that increase in money doesn't yield an increase in the price level, you need a theory to explain why it doesn't yield an increase in the price level, why it boosts GDP. And then the response, which I've seen, is that, well, the economy is not at capacity. And then the question is, when is the economy at capacity, and what is the theory which tells you when the economy is at the capacity? Because so far, if someone would tell me 5 years ago, or even before that if we have an increase in money-funded government expenditures, and GDP increases by the same amount, then there doesn't have to be an increase in inflation, I would say yes. Under those assumptions, yeah.
Right.
So then it's a little bit what's new to me, and of course there's going to be alternative things that may be new, maybe not, but things that the mechanisms of how it really works and so on, it could very well be new, but I never engaged at that level of things. So,
hey, Pontus, do you know who Warren Mosler is?
Yes.
So I had him on this podcast. That you're in a long tradition here of distinguished guests.
Interesting.
And I wasn't debating him. I was just like having him lay out his views. Yeah. But that is one thing I asked. As I said, look at. It's a pretty standard, MMT position that it's not a problem for you to pay for things. You're always going to be able to get the money, and you guys all admit it's not, we're not giving a panacea. We're not saying just print money and then, everything is magical.
Yes.
And I said, but in practice, like how much spare capacity do you think we're leaving on the table year after year? Because in other words, like standard Keynesians, like new Keynesians, like Paul Krugman, think that there's some slack, that there's a role, especially in the liquidity trap.
Yeah.
And so it seems to me the MMTers, in order in practice for your position to differ importantly, you have to think, even when Paul Krugman says, okay, yeah, there's no more room here for inflationary finance expenditures, that you think there are. And so I was, could you fund a Green New Deal or single payer healthcare or put a Martian colony just by printing money? And we had this. So he didn't really answer that. The one thing I think that some have said to me is they think a job guarantee would really unlock. In other words, they think that's something that's broken, not just in the wake of a bad recession, that they think that's a permanent feature of laissez-faire capitalism, that, the labor force is permanently below what it could be doing. So anyway, but I agree with you that I was trying to pin them down and say, okay, in practice, how big a deal do you think that, how much unused slack do you think there is?
Yeah, because that's really the question I would like to know as well. And I would like to know if they have any theoretical foundations of how we can measure that and how we can know, because I'm completely with Krugman on that side, in the sense that, in a situation of a deep crisis or in a liquidity trap, there's ample scope of using any type of monetary stimulus, including expanding money supply, to fund government expenditures and thereby boost the economy, because we are very, very far away from potential GDP. But, can we do it always? My inclination would be no. Do we have data supporting what I just said? Yes. So, I want something deeper, but there's also this attitude, which is not only with that monetary theory, modern monetary theory, comes another somewhat smug attitude that you guys are just too dumb. And speaking of you said this, you come from an Austrian tradition, and you got your fair share of why don't you learn some mathematics and so on. And the same thing happens here. You get things like the same group would say mainstream economists don't know mathematics. They're deeply incompetent when it comes to math, and it's just it comes from a place of disdain rather than an honest assessment. So, and that has made me a little bit disappointed and jaded with this. I mean, I actually have on my computer right now, I have one of the tabs on my web browser has this textbook by a man called Mark Lavoie, I think. Are you familiar?
I don't think so.
So Mark Lavoie, I think he's a Canadian economist. He has a textbook on post-Keynesian economics, and it's supposed to be a good textbook. And I was planning to at least read the first 3 chapters. So I still have a bit of curiosity to see what's different. And I'm sure there is a lot of things that can be learned from many different viewpoints, and many ideas in the mainstream of econ was at one stage considered heterodox, and eventually people realized that this makes a lot of sense, and let's just reformulate it in a way mainstream economists can understand it and take it from there. And so I still have a bit of an open mind, but getting into these Twitter discussions which becomes just a nasty mud fight, I lost interest.
Folks, let's take a break from the action for this word from one of our sponsors. Gold prices are now at an all-time high, but price appreciation isn't the only way to profit. You can earn a yield on gold, paid in gold, without selling your metal. Unlike dollar yields that can be slashed or even go negative, a yield on gold, paid in gold, means you're earning more ounces in your account every month. Monetary Metals allows you to earn up to 4% on your metal in their gold leasing program, and you start earning that yield immediately upon funding your account. The yield you earn is paid in ounces of physical gold, which you get in addition to any price appreciation on gold that might occur during the year. Now you can step outside the dollar system entirely and compound your wealth in a asset that's not a central bank liability. So the question's this: why earn in dollars when you can earn in gold? Join thousands of investors, and that includes me, I participate as well, who are earning a yield in physical gold annually with Monetary Metals. The link you want to go to is monetary-metals.com/Murphy to learn more. Once again, go to monetary-metals.com/Murphy to see how you can participate. Okay, let's get back to the show.
Okay, well, I mean, I think most people think that social media in general probably is a black hole for people's productivity and so on. But
Yeah.
the reason I liked your thread and was intrigued and wanted to have you come on here and talk a bit about it is that there you weren't merely talking about, oh yeah, when I was on Twitter, I tried to talk to these guys and, they were just retweeting me and making fun of me. Like you were actually going to seminars and doing presentations and things and going. So that's, well, let me try it this way. So for example, one of the things that I'm intrigued by is I do want to learn more about like the work of Hyman Minsky, because as you and I said early on in this discussion, the mainstream macro guys, as of 2005, a lot of them didn't even have banks in their models when they were trying to explain the boom bust cycle and thought, we got everything figured out.
Yeah.
So you can see how an outsider would think, this is crazy. How can you guys be this blind? And then, in 2008 say, yeah, we told you so.
Yeah.
And so what is your position on that? Are you saying that, like some of these outside, because likewise too, the Austrians, our theory of the business cycle involves credit expansion. So it heavily involves quirks of the banking system. Saying like during a boom period, interest rates are pushed to artificially low levels and that, gives false signals to entrepreneurs and things like that. So what do you think about that type of thing? Is it just saying, yep, they got some interesting ideas, but we have to make it rigorous, and that's why we got to absorb those techniques or that subject matter into rigorous, Bob Lucas approved models? Or anyway, you get what I'm asking, right?
Yeah, I do get what you're asking, and I think it's a really good question as well. I used to teach this course at Cambridge in the second year bachelor students, but we kept the level quite advanced. So we actually went into these micro foundations of macro already in the second year. And when I explained what micro foundations were, and I tried to explain things like the Lucas critique and so on, I also explained that while one benefit may be that we get greater detail and greater rigor when it comes to describing the economy, drawback is that it really slows down research. Because, as you say, you mentioned these investment signals and that people react and pull the brakes and all these things that we can probably recognize as human behavior acting in an economy. When you try to formalize that, it's extremely complicated and it takes a very long time. And to be honest, I think that to some extent, getting this Bob Lucas approved model and the ambition to always have that, it could have been, sometimes it's been probably taken too far a little bit. I know there's a professor at the London School of Economics, Benjamin Moll, who is very much pushing for this idea that when we analyze heterogeneous agents, which has become very, very trendy to do in macro for the past decade, one complication of those models, which was for a long time a complication so great that people thought we cannot even deal with it. And that's why, mainstream macro had these representative agent assumptions working for such a long time. But, now we have overcome some of those technical challenges, which is a little bit weird. We're not going to analyze inequality over the business cycle or the interaction between inequality and growth because we lack the mathematical tools. And then the mathematical, I'm saying that's a negative thing, right? It's such first order important topics that we need to analyze them in one way or another. But maybe you could only do that 15 years ago if you had a non-approved model, Bob Lucas approved model,
right?
And that was not allowed, or at least you wouldn't be allowed to publish in top journals, which meant your career was over. But having said that, this Benjamin at LSE, he is a bit trying to push this agenda that we can, instead of doing 100% of the analysis with this extremely challenging mathematical and computational framework, we can probably get 90% of the same result with much, much, much less effort if we're willing to relax some assumptions, which are unrealistic anyway. So, for instance, in those models, as in all models, you need to form an idea of where prices are going to be. So you need to know, should I defer this investment, or should I do it now, or should I buy an apartment in 5 years, or should I buy it now? And all these things have expectations of prices. But to fully understand where prices are in an economy like that, I need to fully understand what the entire distribution of individuals in the economy will be, and I need to forecast that distribution. And forecasting one variable is a hard thing. A distribution is a very different object. And he's saying it's also unrealistic. People don't form expectations about prices looking into the future, starting by thinking about what the distributions of buyers and sellers in the market is going to be. It's more of a ballpark estimate where we think demand is heading, right? So, yes, I do think that sometimes, this way of emphasizing or always demanding a certain amount of rigor that may be a little bit over the top can at least slow down things. I think the interesting stuff eventually comes out, but it may slow things down. I mean, it took it took many years from the Lucas Sargent type of models to get a Keynesian feeling to them. And before that, it was all these what we call real business cycles, where demand didn't matter and everything was about supply and so on. And clearly that was, maybe that was the right thing to think about the economy in 1976, but it certainly wasn't the right way of thinking about the economy in 2008.
So just on that point, let me give one version of that history and then see. I'm curious, Pontus, if you agree.
Yeah.
So, I think even like what I'm about to say, Krugman would agree with the spirit of this. That in the 50s and 60s, you had like what you might call hydraulic Keynesianism, and it was there were no agents in the model doing it. It was just macro aggregates and patterns of statistical patterns over time.
Yeah.
And then, but in that old framework, it was like the policymakers could either choose between, do we want to have high inflation or do we want to have low unemployment? And you could go back and forth. But then in going in the 70s, the so-called stagflation, the reason that was like a crisis for old school Keynesian demand management models was that should have been impossible. You were supposed to choose one or the other. You weren't supposed to, and then some of those like long-standing critiques from guys like Milton Friedman and then Robert Lucas and so on, really people said, okay, these guys actually had an issue. Yeah. Once you bring in expectations, you try to give micro foundations, these macro models, you see it doesn't work.
Yeah.
But then, and so here Krugman, I think, would say, they were largely correct, up to, I think he was saying that, I think he was getting his degree in the 70s or something. That, we realized the challenge coming from the freshwater economists. But then Krugman says, when he tells the story, the pendulum swung too far the other way, and you had these pure real business cycle models where everything was just, the reason recessions happen is there's a productivity shock, and then workers rationally consume more leisure while they wait for the conditions to change so that, and then like, and the punchline is, Krugman and those guys said, so they're, Lucas and these guys and Sargent and, Fama, their explanation for the 1930s was it was the Great Vacation.
Yes.
What a bunch of idiots. And so Krugman, and then after the 2008 crisis, Krugman had written some stuff like for his New York Times column and blog saying, I understand why the old crude, ISLM framework didn't have micro foundation, whatever. But he said, you know what? That performed better 2009, 2010 than some of these hyper rationalistic, strong micro foundation models. Anyway, that was his kind of take on that stuff.
Yeah.
How do you feel about that?
Well,
narrative?
so I respect Krugman a lot. I when he writes about politics, that's one thing. I don't want to deal with that. But when he writes about macro, I like his writings and I like his assessments. Now, it's interesting that you bring that up because when the financial crisis happened and I had worked like during my PhD on optimal contracting and things like that. It was a field in macro called new dynamic public policy.
highly technical, and had nothing to do with business cycles. And then the financial crisis happened, and I realized that it's a lot more interesting now to analyze business cycles and the relevant policy responses. One of the articles I learned absolutely the most from was an article by Krugman in, I think it's 1999. It's published in the Brookings Papers of, it's called Brookings Papers of Economic Activity, I think. And it's called It's Back, Japan and the Return of the Liquidity Trap.
Mm-hmm.
And that's a paper that he analyzed in 99. And, luckily, this is also why he was so vocal about policy during that period, because he had spent a significant amount of time trying to understand the liquidity trap that happened in Japan in the 90s. So he was actually quite well informed which policies work and which don't. Now, the model he developed there is very simple. It's an extremely well-written paper. Krugman always writes brilliantly.
Mm-hmm.
It's a very well-written paper. It has a small two-period type of framework where money, there are no banks, by the way, but money is modeled in I think it's a cash in advance setting, which was a way of doing things in the 90s. And it's extremely insightful. And I would say every single thing he spoke about and wrote about in his blog and in his books following the financial crisis is coming from that model with little spins. Now, I know that he many times in his columns phrased it as it's all ISLM, but it's really that framework, which is like a modern twist on the ISLM. But I don't think he wanted to write it like that because he wanted to reach a broader audience. So, my view of that is the ISLM probably did a decent job in that recession. But I think the framework that I looked at for more internal consistency was Krugman's, which probably gets the same message. But I just think the ISLM, I find that a little bit of a hard to swallow type of model because of all this. I mean, you alluded to this before. There are really no agents. They're just some rules about behavior here and there. There's also this LM curve, which stands for liquidity money, which is really relegated to it made sense where physical money was something that was extensively used, but it's not really today. And so it's a model I have a hard time digesting, but versions and insights coming from the ISLM was also part of this paper by Krugman at that time. And I think it's a great paper. That was, by the way, it's a paper that then got a more DSG interpretation by Gauti Eggertsen and Michael Woodford. That sort of, they essentially took that model and put it in a more souped up technical form and numerically analyzed it and so on to essentially show that the logic holds up in a more complicated setting, and that later got also expanded on by a famous economist at MIT called Ivan Verning that managed to squeeze out even further insights from that model. So it's more people I think know about Eggertson's and Woodford papers and Verning's papers than this hidden gem from Paul Krugman. Is that an okay answer?
Yeah, definitely.
Yeah.
If let me ask you one thing for sure. I wanted to get you to elaborate on it. So looking through your slides. So again, the context, do I understand it right? You were a discussant. The Steve Keen had come and presented, and then you were a discussant. And so I'm looking. So folks, Pontus had sent me his slides, and I like this one. So the name of the title of the slide is Endogenous Money, and you're just going through and kind of summarizing, and then you say. A bank that cares about profits cares about revenues and costs. In Keen's framework, they care about neither. And then you have another bullet point. You say, in addition, banks are not entirely unconstrained here. Apart from credit demand and deposit supply constraints, there are reserve requirements, capital requirements, and I find it hard to believe that banks can create deposits one-to-one to loans. So this is just to give you a little bit of context here, Pontus, that Steve and I had recently been on a podcast where the hosts are natural scientists. I forget exactly what they work on. I think physics, but maybe I'm off on that. And anyway, and then for whatever reason on their podcast, they were really into fractional reserve banking. And so they had Steve and me there to kind of give compatible but different perspectives. And we agreed on most of the stuff. But then near the end, like I was explaining my differences, and I said, yeah, the problem is with people who are stressing, oh, banks just create money and you don't need, the old fractional reserve money multiplier theory in the textbooks is wrong. And banks is just gratuitous ex nihilo creation, the act of grant. And I was saying, yes, that's true looking just at the transaction, but I mean, there are some concerns. They can't just create quadrillions of dollars. Yep. That you got to worry. Like if someone goes to the ATM and wants cash, they have to be able to do that. Otherwise the game is up. And I'm not saying Keene himself, but his fans don't seem to realize that. Like they think that central banks have nothing to do with it. They're like, oh no, money's created by private banks. And if you still think the Fed has something to do with inflation, you're an idiot. And anyway, I'll stop there. But you see that.
I agree with your. I mean, I think our thinking about that aligns quite well, right? So, and I normally would ask when people would make statements like that, and this was a big thing in the UK about 10 years ago. People spoke about this. Banks create money out of nothing, and it annoyed me a little bit because, and for the simple reason that it gives the idea that the CEO of a bank can just create a lot of money, stuff his pockets, and go and buy 10 new super yachts and live like Leonardo DiCaprio or whatever, and they can't. That's what a central bank can do. The governor of a central bank can do that, but private banks cannot do that. And that distinction between that means that banks do not create money out of nothing; they create it out of something. So, and I normally would in Twitter debates, even though I was a little bit apprehensive engaging fully, I would ask people making those claims, like the followers of Keene, I would ask them, if banks create money out of nothing, out of thin air, why do we need to bail them out?
Yeah, great.
And if you don't know how to answer that, I'm not going to continue listening to you and you harping on about banks creating money out of nothing.
Yep. Okay, great. Let me just, do you have 5 more minutes?
Yeah.
Okay.
That's it.
I'm just curious because you had mentioned Sweden and whatever. So I'm curious, are you at all familiar, so Ludwig von Mises, the Austrian school economist, his theory of the business cycle, one way of putting it is that he kind of integrated his view of applying subjective utility theory to money demand, but then marrying that to Knut Wicksel's writings on the so-called natural rate of interest.
Yeah.
And so I'm just wondering, is any of that on your radar? And I'm wondering if that's something that do economists in Sweden still care about Wicksell, or is he just, he's ancient history?
We care about Wicksell. But one of the reasons is that, so I did my undergraduate at a place called Lund University, and that was also where Wicksell was a professor way before me. But the university is, of course, very proud of him, and we care about him in the sense that, to some extent, many ideas that we use in econ in mainstream, but even in heterodox circles, normally goes back to some brilliant mind maybe 100 years ago who at least spoke about it, even though they never formalized it. So Wicksell, for instance, as you said, the neutral rate of interest is, of course, something that I think most mainstream economists would be very well aware that it was Wicksell that was behind that. But more than that, I don't know. I can correct you on one thing. In Swedish, you say Knut.
Okay.
So the K is actually pronounced. But yeah, no, sorry, but it sounds interesting what you're talking about, and I would be happy to read more about it.
Okay, yeah, I don't want to give you homework, but yeah, I'll send you something on that just so because again, it's an interesting. Since you are interested in heterodox views, and that's why I was telling you there is an affinity between Mises' theory of the business cycle and Hyman Minsky. It's just, of course, their policy prescriptions are vastly different, but they both like view, there's this buildup of unsustainable private credit that, causes investments that are not compatible with long run equilibrium. Put it that way.
And what you're saying there, I think, is like, it's one of those things, this unsustainable debt leading to misdirected investment. I mean, and corrections in situations like those, corrections that can lead to deep recessions, is clearly something that, I immediately have some intuitive, I find intuitive appeal in that it seems so reasonable. And even though I haven't been digging into it myself, and maybe I should, but it's this thing that, I've throughout my career, I had many ideas that once I put it down, I put it down on pen and paper, I got the demand, I got the supply, I have some notion of an equilibrium. It just didn't work out. And very often it's that, damn invisible hand that just comes in and fixes everything. And you need to either add more assumptions. Maybe prices need to be sticky. Maybe there needs to be, some real frictions in the economy that construction workers cannot become nurses overnight and so on. Whatever. These can be realistic assumptions, but they nonetheless turns out to be important assumptions. In many ways, I've learned a lot from that in the sense I've learned I need assumptions I didn't intuitively think I needed. The other thing I've learned is that story that I thought I had intuitively simply does not play out in general equilibrium, at least not under the assumptions I had. And then you need to go back to the drawing board. And that's a little bit, I kind of want to see theories like that, getting the nuts and bolts together so I can understand them. Like, let me give you an example. If you take a infinite horizon model and you want to study asset price bubbles, you very quickly reach the conclusion that in a model like that, asset price bubbles are impossible.
Yep.
They violate something called the transversality condition, and which means it's not optimal. But then you make one simple change in the model, and that's people are finitely lived. They're not infinitely lived, and there's an overlap of generation succeeding each other, and then all of a sudden bubbles is a naturally occurring phenomenon. And it's that type of understanding how the assumptions work and how they lead you to economic insights is something I find very interesting and fascinating.
Yeah, I found that in my work too, that in capital and interest theory in particular, that certain things that I think were assumptions made for mathematical tractability were driving results that people didn't realize, that, oh, wait a minute, that's not just a harmless, innocuous little thing to make the math easier. Like, that's driving this one type of result. So
completely agree.
Okay, well, that's a great spot to wrap up. Folks, my guest has been Pontus Rendahl. Thanks so much, Pontus, for your time here and relaying some of your battle stories, and good luck in continuing to be open-minded and transferring truth from discipline to discipline.
Thank you.
And thanks, folks, for tuning in. See you next time.
You've just experienced another episode of The Bob Murphy Show, the podcast promoting free markets, free minds, and grateful souls. For more information and to subscribe to this podcast, visit bobmurphyshow.com.